We're live from the Ben Reinberg I Own It studios today, and we have an incredible guest that I'm very grateful to have on the show. And this gentleman's in my business, which is always a privilege when you get to speak to other commercial real estate icons and learn more about the business that we play in on a daily basis. So I'm very grateful. Richard Stockton, welcome to the show. Very grateful to have you on and have a commercial real estate colleague come on to share his knowledge. And so thank you for joining us today. We appreciate it.
Thanks for having me on, Ben. I'm eager to chat to you all about the industry.
Great. So let's get started here. Let's talk about just sharing more about the context on your background and your passion for real estate investing. Give us a little background on Richard Stockton.
I've always been enamored with real estate. You know, from a young age, as a teenager, I decided I wanted to go to school and study real estate and finance, and I went to Cornell. And the program that was available there at the time was within the hotel school, and so it was a hospitality overlay to the industry of real estate finance. And I learned a lot. I learned a lot on financial modeling. I actually got a real estate license at the time. I must have been 20 years old, and started working for a commercial real estate broker in Ithaca, New York, part-time while finishing up school. And then from there, went straight into real estate consulting. I worked at Price Waterhouse for a number of years, and then went back for an MBA, and where I continued to dig into real estate and finance. Out of that MBA program, I joined Morgan Stanley, where I've spent the bulk of my career, spent over 15 years working in real estate investment banking and real estate investing all over the world. And so I was based in New York for 3 years. I was in London for 10 years. I was in Singapore for 3 years, and then returned to the States, I guess it's about 10 years ago. For the last 6 years, I've been working in Dallas, Texas for a company called Ashford Inc. I'm a senior managing director there, with a couple of different responsibilities, one of which is a CEO of a publicly traded lodging REIT called Braemar Hotels and Resorts. But I'm also the fund manager for a new fund that we're raising to invest in Texas real estate, Texas commercial real estate. And it's really capitalized on all of the mass migration trends we're seeing coming to Texas, and it's happening right in our backyard. And it's actually a real exciting place to be from a real estate investment perspective.
Who are the type of investors that can come into that Texas fund? Is this accredited investors, institutional capital? Who are you getting money from?
For this fund, we're raising it through the retail investor channel. So individual investors, average ticket size is $50,000. We have an in-house FINRA registered broker dealer called Ashford Securities that then establishes relationships with financial advisors across the country and builds a selling syndicate that allows us to raise these real estate funds.
That's great.
Yeah.
So you run a REIT, which is worth over hundreds of millions of dollars that are focused on hotels and resorts. For my listeners who may not be familiar, give me some flavor of what a REIT is and the kind of investments you focus on.
Yeah, sure. REIT is a tax classification from the IRS that was put in place first in the 1960s and has been slowly modernized since. Essentially what it is it's a corporation that elects to be taxed as a REIT, which means it has to follow certain rules in order to be federally tax exempt. And those rules are, well, you have to invest primarily in real estate, and you have to distribute at least 95% of your, or 90% of your net income to your shareholders. And you also have to be widely held. So it can't be a controlled vehicle. And that corporation, which elects to be taxed as a REIT, can either be a private or publicly traded. In our case, it's a publicly traded REIT, and we have thousands of investors within the REIT. We own 16 luxury hotels worth about a little over $2.5 billion. And we're publicly traded on the New York Stock Exchange. So it's a way to enable individual investors, and this is how it came about, individual investors the opportunity to invest in real estate, which would otherwise be an asset class they wouldn't have the ability to invest in due to the general ticket sizes of buying commercial real estate. So they can buy just the shares in a company that owns the real estate. And in our case, ours focuses on hotels, but there are REITs for every different sector, whether it be office, industrial, retail, multifamily, data centers, etc.
So as we know, the pandemic, which we're out of, was a challenging time to be in the hotel business. What was it like for you in 2020? I know I reflect back and looking at my company, we own and manage medical properties throughout the United States. But
Yeah.
I know sometimes I would travel, Richard, and I would be in Savannah, Georgia, for example, and I would be the only one staying at one of these really neat hotels in Savannah, Georgia. And so I took a step back. I'm like, oh my gosh, I can't believe what's going on here. What was it like for you guys in 2020? And did you make any big strategic changes as a result of the pandemic?
Yes. So it's probably the worst year of my life.
Okay.
It was horrible. It was absolutely horrible. At the time, we had 13 hotels in our portfolio. We've acquired 3 since. And we had, at one point, 11 of them closed and locked the doors, right? There were no people. In many cases, government requirements shut down the business.
Mm-hmm.
And we were hemorrhaging cash. And so at the worst of it, I think we were negative cash flow about $12 million a month. And we slowly got that under control. And so that was the focus. It was, how do we maintain liquidity in order to stay alive? And it came through a number of different methods. One was first having a constructive conversation with our lenders. And fortunately for us, we had been pretty big into relationship lending with one of the big money center banks. And they were very willing to allow us forbearance, which is a period of not having to pay interest or principal amortization, which would then accrue until the storm passed. And so for most of our debt, we were able to get 6 months of time to hold on to that liquidity. We also engaged with ground lessors in some cases, who also gave us forbearance. And then we also were working, in our case, with the managers of our hotels. And so while we own the bricks and mortar, we hire companies like Marriott and Hyatt and Hilton to manage our properties. And so we had to have a conversation with them, right, about cutting expenses, reducing staff. And we reduced staff at our hotels either through permanent reduction or temporary reduction, furloughs, by probably 90%. And then that was how we were able to kind of maintain liquidity. So it was working from home on my laptop in the midst of this crisis and dealing with all these parties and trying to hold on to every little bit of cash that we could. So it was pretty grim. You asked, well, what are some of the lessons learned? Have there been any major strategic changes to the business? I think, first of all, once we were able to find our feet from a liquidity perspective, and we had managed our leverage, I think, in a pretty smart way prior to the pandemic. So we were one of the first lodging REITs to be on the front foot when the time came.
Right.
So that's what we took advantage of, the fact that there was a dearth of buyers in the market to buy some great trophy assets. And so we acquired the Mr. C Hotel in Beverly Hills at $474,000 a key. Other Beverly Hills hotels were trading for $2 million a key. We acquired the Ritz Reserve in Dorado Beach, which is one of only 5 Ritz Reserves in the world. It's just an amazing, luxurious property on the north coast of Puerto Rico. White sandy beaches, crystal clear blue water, average room size 1,000 square feet, which is basically twice of what you typically find for a luxury hotel. And then we bought the Four Seasons Scottsdale last year. So we got on the front foot very fast. But now, as we look forward in terms of the strategy, the biggest thing is we're going to have less leverage, right? That while we got through it and we were just fine, we didn't have to raise any rescue capital, we didn't lose any assets to foreclosure, we would have been even more comfortable had we had less leverage. And so going into the pandemic, we had something like 50% net debt to gross assets. And as a real estate investor, you would always say, well, gee, that's pretty conservative.
Mm-hmm.
I think going forward, we're going to focus on 35.
That's
And
good.
so if something goes bump in the night, if we have another black swan event such as this, I think we'll be in a very good position to, frankly, again, be on the defensive and take advantage of a unique buying opportunity.
And let me just touch on what he just said. The key of the business is the ability to hold. And when you have less leverage on a piece of commercial real estate, a property, it allows you to have more flexibility. It allows you to be able to have a conversation with your lender if the value drops. You're basically insulating yourself to allow yourself the ability to hold. That's the key to the business. It's not about location. Maybe in the hotel business, location is important. However, the key to commercial real estate, we all know this, and we preach about this, the ability to hold. And so that's a very smart way to approach what you guys are doing. I commend you for that. So Braemar has properties all across the U.S., and most of them seem to be in states to have large population or travel destinations. Are there certain areas in the U.S. you're most focused on investing in that you guys are targeting?
Well, yeah, right now, in terms of general real estate investing, we're very focused on Texas. And, Texas has led the way in population growth over the last 10 years, and even more so in the last 2 years. And it's the confluence of people, wealth, and corporations all moving to the state and creating jobs. And, it's a result of a very favorable business climate, right? We have 0% personal income tax. We have 0% business taxes. And, some would say a little bit better weather than some of the northern states. Some would say a little bit more favorable politics to operate a business. And there certainly has been some frustration from states such as California and New York. We're seeing a lot of people move from those states as to, some of the new, social policies that have been introduced, and they just rather, be in a state that's perhaps more conservative.
Okay.
And it's created this great environment for investing, right? Because you have new development, you have new people, and when people move into a state for their new job, they need housing. So the multifamily sector is booming. They need self-storage, because anytime somebody's moving, you need self-storage. And then they need their Amazon goods delivered. So there's a need for industrial. So all these areas we're looking into, and then ultimately retail as well. On the office side of things, in some cases, they're moving into shiny new office buildings that are being built in Texas. And it's one of the few places where we still have new office development. But in other situations, it is a remote working or situation, but they still want to be based in Texas, and even if their company is headquartered elsewhere. And so that's been a recent focus for us, and something that we're pretty excited about.
Yeah, and with my company Alliance, a lot of our due diligence, Richard, focuses on supply and demand factors such as population growth and available inventory. And I imagine you have a high level similar criteria. If you could do a deep dive to teach people a little bit deeper into the key things you consider when investing in a hotel property, what are those things you look
A hotel property? Sure. I'll tell you about our acquisition process. First for Braemar, our strategy is to invest in own luxury hotels. And so that's the first criteria. Is it a luxury hotel? There is a classification by one of the major data providers in our industry called Smith Travel Research that literally classifies every brand into luxury, upper upscale, mid-scale, et cetera, economy. And so long as it has that classification, it's a candidate. So what we'll do is, if let's say it's an existing property, we'll do a comprehensive review of the last 3 to 5 years of historical profit and loss, and we'll do a 5-year projection of that P&L, and that works from your top line rooms revenue down to your net operating income, and then we'll we'll apply an exit cap rate to our 5-year projection and come up with a targeted unlevered IRR based on our price. And in the hotel world, and I've invested in real estate, frankly, all around the world and in different property types. The required return that I have is 10%, right? So I'll look for a 10% unlevered IRR. Why do I look at unlevered instead of levered? I look at unlevered because for us as a corporation, leverage is fungible to me. I can have 60% 60% leverage on one asset, and I can have 20% on another. I'm going to put the leverage wherever it's cheapest, such that as a company as a whole, we kind of stayed to that 35%. And that's notwithstanding the fact that I can have corporate level unsecured debt as well, right? So I look at unleveraged IRR. The other thing I look at is yield on cost, because particularly in the hotel business, you have to continuously invest into the property. And so it's a little bit of a game, because the more you invest, generally the higher rates you get, and therefore you can generate more NOI, but you don't know if you've invested too much or too little. So what I do is I look at my starting cost, which is my basis, and every year, whatever CapEx we put into the asset, it accretes that basis. And so I have a higher basis, and I look at what is my NOI divided by that basis, and that's my yield on cost. And so when I'm buying a new asset, I'm trying to target at least an 8% yield on cost within 3 years. And that gets me to a yield on cost that exceeds my cost of capital, my weighted average cost of capital as a company. And, that weighted average cost of capital has been moving around quite a bit lately, as I guess with interest rates.
Mm-hmm.
But we're still focused on that kind of long-term, achieving at least an 8% weighted average cost of capital. Over the last year, we have been issuing preferred equity as our form of funding, which has a 7.5% distribution yield. And so if that's my cost of capital, and I use that capital to buy an unencumbered asset, and I exceed that, we're creating value for shareholders. And as I look back over the last 6 years at all the acquisitions we've done, and I do an overall average of my yield on cost, averaging right now over 11%.
Oh, that's fantastic.
Yeah.
Well done. So how do you choose what hotel brands you invest with? Because I know you guys own Hiltons and Marriott's and the Ritz-Carlton, some of the things you've touched on previously, as well as some others. How do you decide which brands you want to invest in? Is there something you lean into, or how does that work?
Yeah, we invest in both brands and independent hotels. So 4 of our 16 are independent. Those are managed by an affiliate manager of ours called Remington. In my experience, our independents that are managed by Remington can generate significantly higher margins than the branded managers, but they lack the loyalty programs and the distribution channels that you get by having a branded hotel. So in that way, we're kind of agnostic. We'll do either. I will tell you that the brand that's most prevalent in our portfolio is a Marriott-based brand, which is Ritz-Carlton. And so we have the Ritz-Carlton Lake Tahoe, the Ritz-Carlton Sarasota, Ritz-Carlton St. Thomas. We have the Ritz-Carlton in Dorado Beach. And they do a great job for us. And so we're definitely open to working with Marriott on any new acquisition. I think we've also had a very positive experience with Hyatt, a very positive experience with Hilton. We just bought our first Four Seasons, and that property had already, we bought it in December of last year, and we bought it based on numbers that were budgeted in August of that same year, and they significantly exceeded the budget between the period of August and end of the year. And so we've been very happy with Four Seasons. And suffice to say that Four Seasons, which is the property we own in Scottsdale, just had an incredible weekend. So last weekend in Phoenix, as you know, you had the Super Bowl and you had the Phoenix Open.
That's right.
Our average daily rate was $4,000 a night at the Four Seasons at
I actually stayed at that hotel right when it opened, a week after it opened. And they somehow they hacked me for taking a timeshare tour.
Okay.
It was actually like it was probably a few months after my first son was born.
Okay.
Staying there, it was brand new. It was pretty rustic out there, but it was fantastic. I've stayed at the Ritz-Carlton Lake Tahoe. I think I did. It was a few years ago. That's a gorgeous piece of real estate. Incredible food. If everyone out there, if you ever get a chance to be in Lake Tahoe, this is an incredible experience to stay at the Ritz-Carlton Lake Tahoe. I believe it's a ski in, ski out
It is. Yeah.
type atmosphere, and it's just great. They got the fireplaces and multiple levels and just incredible service. So fantastic hotel that you guys own. It's very impressive. I do have a couple of hotel economic 101 questions for everyone
Yeah.
out
What do you
there
got?
that my audience might find interesting. Explain to everyone, what is RevPAR and how do franchisee models work?
So first, RevPAR, revenue per available room. And so essentially it's your rooms revenue divided by your room nights sold. The shortcut way to get to it is if you multiply your average daily rate times your occupancy, and that's how you get to RevPAR. Our RevPAR at Braemar is about $300, which is the highest RevPAR of any of the lodging REITs that are publicly traded. And RevPAR is directly correlated to the quality of a hotel, right? So the higher the RevPAR, the higher quality of the hotel. And with a portfolio such as ours, which is primarily luxury, we run at a very high RevPAR. But you also have to make money, and so while we look at RevPAR, we have to also look at what margins are falling to the bottom line. And we've been running at about 30%, a little over 30% EBITDA margin across our portfolio. So that's pretty healthy generally. And a lot of people think, oh, well, you own luxury hotels, they don't make any money. The right ones make a lot of money. And particularly where average daily rates are now, we've seen margins on some of our properties that they've never touched historically. So we're getting in some cases excess of 40 and 50% EBITDA margins on our luxury hotels. How does the franchisee model work? Well, as relates to Braemar in the luxury space, we don't really have franchises, because a franchise is a situation where you're essentially borrowing the brand, and that allows you to put your hotel into the central reservation system. You can find it on brand.com, which is a generic way of saying Marriott.com for whatever brand. But in the luxury space, the brands, if you're going to use their luxury brand, they also want to manage the property. Once you get out of the luxury space and say you're talking about a Courtyard, you're talking about an Embassy Suites, in that case, you have three parties at the table. You have the owner of the bricks and mortar. You have a company that's a third-party management company. I mentioned this company, Remington, before, where all they do is they manage the hotel, but they don't have a distribution system. They don't have central reservations. And then on top of that, you layer the brand, and that's the franchise agreement. Franchise agreements, in some ways, cost the same as management agreements, where you get the brand along with it. And so you say, well, why would you ever franchise a hotel? Because you have to pay a franchise fee to, say, Marriott, and you also have to pay the manager on top of that. And the answer is very simple. In many cases, you can drive much higher margins by doing it that way. And it depends on the product. For as great as those brands are for driving the top line through their massive distribution systems, they also, in our humble opinion, have a tendency to apply a little bit too much staff to the hotel, a little bit too much labor, and you could probably get away with less or less expensive labor, maybe, if you have a third-party manager involved under a franchise arrangement.
How are you seeing what's going on in this economy? There's been rising interest rates that pared down a little bit the spreads recently.
Yeah.
What's your opinion? What's going on in the economy? Where you see interest rates going? And a lot of us felt we were in a recession quite some time ago. How do you feel now? Now that you see where we're at and you see what's going on, there's a lot of layoffs going out there. We hear about it. I live in Orange County, California. It just seems to be booming here, and we're not as affected by the economy. But being in Texas, and obviously you have great leadership in Texas, and the economy seems to do well. You look at the city of Austin, Texas, last few years, housing values have skyrocketed. Whether you're a condo and a house down there, just the price per foot is just astronomical, even with the migration from California and Arizona
Yeah.
coming into Texas. But how do you view the economy, just looking at it overall? Like, what are your thoughts?
I'll tell you, since last year, I've been saying the risk of recession in 2023 is very low. And to the extent we did face a recession, it would be very short and shallow. Maybe a technical tenths of a percent lower year over year GDP growth doesn't really affect the economy overall. I think at that point, you're starting to look sector by sector and geography by geography to figure out if you've been the one affected. Is it your industry that's causing the drop in productivity? So it hasn't been something that for us in the lodging industry has concerned me really at all. Historically, there has been a pretty strong correlation between GDP growth and RevPAR growth, but it varies. And this is one of those points in time where it's completely disconnected, right? Where we're able to drive top line ADRs in a way that we've never seen, which was resulting in higher RevPARs than we've ever had as an industry. And this is against the backdrop of a high interest rate environment and the risk of a short and shallow recession. I think with interest rates, there sounds like there's still more work to do to get inflation under control. This is the hangover from the incredible amount of stimulus that was pumped into the economy in order to save us from COVID, and in the form of government stimulus to businesses, but also helicopter money, right? The stimulus program that came to individuals, in addition to a very low interest rate environment, which is also increased money supply. So it's all these things. It's very difficult. You just throw everything at it. It's very difficult to get exactly right. It looks like we overdid it. That has therefore caused inflation, which we're now going to have to get under control. And it's not something that's very scary. It's unfortunate that your base rates have to be so high for the next year or so. I think it's at some point, it's probably looking like next year the Fed pivots and starts to reduce, and we get to kind of a more normalized interest rate environment. And what that means to me is kind of 2 to 3% on the front end, and kind of 4 to 5% on the 10-year. And that's a nice positively sloped interest rate curve in a normalized environment. But it's going to take a little while for the Fed to do that. I think when the Fed does pivot, the stock market goes nuts, and we have the replacement of a lot of that value that's been lost in terms of asset value in the stock market. As for layoffs, we're at an all-time low unemployment, right? The last unemployment figures that came out were at a 53-year low, maybe not all-time low, but 53-year low.
Mm-hmm.
And what the media loves to do is to sensationalize whatever they can. And I think, that's what we've seen these news stories about tech layoffs that have made all the headlines, but it's really not emblematic of what's happening across the broader economy. I know in the hospitality industry, we're still trying to hire people like mad, right? We're still trying to get back to the levels of staffing that we had pre-pandemic, and we're not there yet. So I think it's really depending on what sector you're in.
Yeah, I was going to touch on that. I mean, during the pandemic, and even afterwards, especially with the stimulus money, a lot of people are staying home, and they're not taking advantage of getting a job. And so has it been a challenge to recruit talent? I mean, I go out and eat frequently, and I see the restaurants, and it's starting to come back, and it seems like more staffing is happening at restaurants and hotels. But there would be hotels I would stay at. I travel a lot, especially I've been to your hotels, and it seems to me like even now some of them are still understaffed. How do you solve that challenge, and what do you do, and what's been your experience in dealing with this? Because to me, it's just so sad to see you walk into this gorgeous hotel and they have it's just a struggle to be
Yep.
able to staff it and really provide that luxury service that you guys provide, that great service. So how do you deal with that?
It's been hand to hand combat,
Hmm.
and it's been slowly climbing back. If you think back to April of 2020, we were at probably 10% of pre-pandemic staffing levels,
Hmm.
and then we added up until the end of last year. For our portfolio, we were something like 85%.
Hmm.
Right, so we're getting there, but it varied by hotel. The Ritz Carlton Lake Tahoe that you refer to was running at 65% of their staffing levels, which frankly did put strain on the level of service.
Hmm.
And that's against a backdrop of much higher rates as well because of revenge travel and just a lot of demand for hotel rooms. So we did get some unhappy guests. What you do in those circumstances is we had to backfill with contract labor. So these are shorter term employees that are less well trained than full service full time employees. And then we would continue to try to hire and attract. And I'm on the board of the American Hotel and Lodging Association, which is our big kind of trade group. And one of the big initiatives, particularly last year, was attracting workers back to the hospitality industry. And so we put a lot of money into advertising, print, and internet, and to popularize the hotel industry and hotel jobs, and to kind of explain what's available. And it's worked, and it's actually gained momentum because of the tech layoffs, right? So those individuals that left our industry to go work in an Amazon warehouse or be a driver or something have now started to come back, and so that's clearly a very favorable trend for us. And we're going to get back to where we were. I think the other thing that we found is, and this would be normal, is that as you build up your staffing over a long period of time, you create some excess capacity in the system. And so we're probably able to hire back to a level below 100% of where we were pre-pandemic and still have a full service experience, because we probably were a little bit overstaffed, frankly. And so that's just helping us with our margins.
Do you feel that you're paying these people a lot more than a year or 2 years ago? It could be double, maybe 60% higher. What are you seeing in their wages that, because because you're competing with people, because when talent is out there, you got to pay up. We see that in my company, whether it's property management, maintenance, third parties, internal staff. We are paying significant dollars to keep people because there it's the only way to me, besides a great culture, and I'm sure you provide a great culture, is you must see a significant amount of labor expenses on your
Yeah.
income statement.
Yeah, we saw the cost of labor jump in 2020 and 2021, but less so 2022, less so. We're budgeting labor to be up probably mid-single digits this year, and it's been the cost of labor has been increasing for I say three primary factors. One is minimum wage, right? So there have been a number of minimum wage legislative actions that have come into effect over the last 3 years.
Hmm.
And those things are things that have been passed in 2018, 19, 20, and they kind of layer themselves in over time. So you have that. You continue to have the strength of unions, and so the unionization of labor is certainly a trend that's alive and well. And when you unionize a property, there comes additional cost, and we've certainly unionized at least certain departments of our properties over the last few years.
Hmm.
That's something that's part of everyday life now. And then it's just the overall pressure of unemployment, right? With unemployment where it is, in order to attract the best talent, you've got to compete with these other industries, and you've got to pay up to get people.
That's right.
And so we've been seeing all those three factors drive up cost.
Yeah.
Now, luckily for us in our industry, though, we've been able to grow our top line at an even greater rate than those costs have increased. So our margins have held, in fact, have increased. over the last 3 years.
All right, that's great to hear. And definitely check out Ashford. It's Ashford Hotels, right? Is that the website?
So people should go to BHR
Uh-huh.
REIT, BHRREIT.com. That's Braemar Hotels and Resorts. We do have an affiliate company called Ashford Inc. that you're referring to. But if they go to BHR REIT, you'll be able to see all of our beautiful properties and great pictures of, to Lake Tahoe and Sarasota, Florida, and St. Thomas and all
Yeah.
that.
You guys have beautiful hotels, and keep up the good work. I think it's fantastic. So we're all works in progress. Okay. And the name of this show is I Own It. And what that's about, Richard, is owning every aspect of your life. Was there a time in your life that you realized, I just don't own it? Something that happened that you could share with our audience, that they can learn that, hey, even though you run this great company, you are human. And there's times where we don't own it, and we look at and reflect back and learn from those experiences. What time in your life was it where you didn't own it?
Huh. That's a tricky one. I guess I would say, there was a job that I had in between this one and Morgan Stanley,
Mm-hmm.
where I was trying to get back. I was living in Singapore, trying to get back to the United States. And I worked in the position for 2 years and felt like I probably wasn't driving it hard enough to grow the business, and probably got a little too complacent. And then ultimately, the company and I parted ways. And I think there was a lesson learned for me, in that. I also probably needed to consider the views of the people around me a little bit more. It was kind of a complicated organization where I was running a business. I was CEO of a business in the U.S. and reported to people in Singapore that owned it ultimately. But I thought I could do whatever I wanted on my own, and take their input less seriously than I probably should have. And so, if I were to redo it, I would certainly approach it a different way and be maybe a little bit more humble, a little bit more understanding, and a little bit more collaborative.
Yeah, it's a great lesson for everyone out there. One of the things I've learned that I can share with everyone out there is that when you're listening to others, seek the truth in what they're saying. You might not agree with them, but if you could seek the truth and understand, because everyone you engage with will contribute to your life. And it's something I had to learn as I aged, especially in commercial real estate, is that you have a lot of people that are speaking and talking and have different opinions and different lenses they look through. So if you could seek the truth in what someone else is saying, guess what? You'll grow faster, you'll learn faster, and you probably will end up making more money too, because you'll build deeper connections with people. So we always wrap up our show, Richard, with 3 questions. And I've been waiting for you to come on. And I always love fellow commercial real estate colleagues because they always have great answers to our questions. So if you're in our studio with me in Laguna Beach, we have a couch, you can't see it. And I say, Richard, lay down, get comfortable. How old are you now?
52.
Okay, you're my age. You might be a year younger. I'm 53.
Okay.
But we're definitely Gen Xers.
Yeah.
And so it's nice to see another one. And we're sitting on the couch, and you're 52 years old now, and you can go back in time and talk to when you were 16 years old. And you are this seasoned CEO. You've been in real estate, commercial real estate, for quite some time. You've learned lessons. You've met a tremendous amount of people. What advice would you give the 16-year-old Richard if you can go back, knowing what you know now, with all your knowledge and experience, and you have gray hair just like me, which I love, and you look great. What is that advice that you can give yourself? What are you telling yourself now?
Yeah. Well, I have 3 children.
Okay.
And they're 15, 16, and 18. I could probably give them the same advice, or I can give myself the same advice. And it's been remarkable to watch them grow up and see everything that they've already accomplished and what they're looking forward to accomplishing. And those are years that I cherish. And I've been working so hard over the last 20 years, and moved all over the world. What you don't get back is the time you could have spent with them, and getting that balance right, I think, is a real challenge, and something that I would tell my 16-year-old self to prioritize it more so, right? Because once they're adults, you kind of look back and you say, that was such an amazing time when they were young, and they really wanted to spend time with me. Now they don't care. But
and let me tell you, as they get older, they're going to be spending less and less time with you because they'll have their own lives and careers.
Yeah, but those are some of the greatest times of your life, I think, spending time with your children.
Absolutely. Great answer. I love that. So it's our last day on earth. God forbid. It's just me and you. And it's our last meal. It's your choice. What are we eating and what are we drinking?
All right. Well, I think what we're eating is a petite filet Pittsburgh style medium.
Oh, baby. I love that. Explain for our audience. They don't know what Pittsburgh style is. I do. I understand it, but explain to them what Pittsburgh
style is. It's charred on the outside, but not overcooked steak. So they put it under a really, high powered burner.
It's a fancy word for seared.
Yeah,
that's how they do it. But being a Chicago guy like me, I mean, I love a good steak. All right, so what else are we eating with the steak?
Well, I do enjoy vegetables. So even though it's my last meal and not attempting to be healthy, because that doesn't matter anymore, I'm probably going to have some asparagus or broccoli along with it.
Cool.
And then I'd say mac and cheese as my my carb.
What are we washing it down with? This meal that we're going to be so full.
That's right. And then to drink, I'm a big red wine fan. So it's probably going to be a very expensive Bordeaux Cabernet Sauvignon.
Yeah, I'm a wine.
Probably the biggest wine glass you can find at the end of the earth.
I love that. I collect wine. I love wine. And sounds like you and I could have dinner anytime.
Yeah.
Even before our last day on earth. That sounds fantastic.
Yeah, why wait?
Yeah, we don't have to. I love the Pittsburgh style thought process. That's a beautiful thing. So in our studio, you can't see behind me, but we have a grand piano, a drum set, and 6 electric guitars.
Oh.
And if you're in studio, and by the way, anytime you come to Laguna Beach and you come this way, you are more than welcome to come in studio and hang out. And we'd love to have you in. It's a real treat to talk to you today. And I'm very grateful to have this conversation. So in our studio with the musical instruments we have, if you had the choice to bring in any band or musician into the studio with us, it's your choice. Now they can be deceased or living to play us one song. Who are you bringing in the studio, Richard, to play a song for both of us?
I'm going to have to go with Van Halen.
Okay.
Led by David Lee Roth.
Wow.
So we're bringing David Lee Roth with
you are a Gen Xer. I love it.
We're going to bring Eddie Van Halen back from the dead.
Oh, baby. Is there a song that they're playing for us?
Well, we'll have them play Jump.
Okay, cool. I love it. I love it. Great choice. Great choice. Well, thank you so much for joining us, Richard. What a treat to spend some time with you, and love your hotels, and definitely check out his website. They're spectacular. I've stayed at a bunch of them, and it's a real treat. And the service is great. They're beautiful, clean facilities. Everyone there is just kind, and you could tell from the way you guys run your operation down to the people that are live at these hotels. Just the culture that you're providing. So thank you. We appreciate it. And I appreciate it from a personal level because I travel a lot. So thank you for making my life a lot easier as I age. If you are interested in following more or listening more to the Ben Reinberg I Own It show, drop kick that right-hand button and click subscribe. Feel free to click on the like button. The more times you click like, the more opportunities we have to share this content with as many people as possible. So feel free to contribute our show to as many people as possible. If you want to understand commercial real estate and learn more about my company, go to alliancecgc.com. We are experts in medical office investing and veterinarian properties. We invest all throughout the United States. We have a brand new fund called the Alliance Medical Property Fund. Feel free to log on if you're interested in investing. We have accredited investors and family offices that invest with us from all over the world. If you're interested in learning more about me, go to my personal website, benreinberg.com. You can follow me on all social media platforms. And obviously, you can click on and listen to all the different episodes of the Ben Reinberg I Own It show. Richard Stockton, thank you so much for joining us today. And it was such a pleasure to see you. We're out.
Appreciate it, Ben. Thank you.